Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
If you're interested in learning more about setting up your own family banking system, send an email to thefamilybankingshow@gmail.com. We'd love to hear from you.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Gents, how's it going this week?
Yeah, November.
Yeah, we're in like a fall. Days are short. Daylight savings just happened, and it's an adjustment. I don't know how do y'all normally go through like a week or two, where you're just like every day's you're just kind of tired. You always wanted to just fall asleep. Definitely wasn't that way a couple weeks ago, but it's definitely been an adjustment back into the shorter days, the colder days, and so forth.
Yeah.
Yeah.
The sun was setting. We were outside a few days ago, and the sun was setting, and it was like not even 5 o'clock.
I know.
It's gonna get pitch black at 5:30. It's just like, that's just weird. I don't like it.
I know. So early, 4:30, it starts to, you can see it starting to set.
Yeah. Well, we're also in the thick of seasonal cold season, so I've been battling a cold for, gosh, it seems like at least a week and a half, 2 weeks, something like that. So, hopefully everybody's staying healthy. Guys, this episode, Rob's been doing some heavy lifting here and thinking about some bigger concepts that Nelson has taught us in his book, Becoming Your Own Banker, about being an honest banker. And Rob's going to kind of trace this back, it sounds like, kind of throughout history. Where did that idea generate? Where did it come from? How did it get passed down? How did Nelson kind of absorb that and utilize that idea in his book, and how we can put it into practice? So Rob, with that, we'll turn it over to you and let you take the wheel.
Yeah, all right. Yeah, so as Derek was saying, is one of the concepts of Nelson's book, Becoming Your Own Banker. He talks about being an honest banker. Don't steal the peas. And I always wondered, where did he get that, and did he invent that? And the answer is, did he invent that financial principle? The answer is no. He did not invent the principle, but he just simplified it for us. And that's I think is like one of the beauties of this book, is he simplifies things. And he, in his parable kind of style, he simplifies some of these like obscure, kind of there's very simple financial ideas, but we just don't, they're never like presented to us in a way that is digestible. Mm-hmm. And so he took big banking and big business practices, and he, as Nelson said, he brought it down to the you and me level. And so I thought our listeners and viewers might find it interesting to get a little bit of a history of where did this idea of being an honest banker come from. And so Nelson, in his book, this book was published in 2000, Becoming Your Own Banker. So he references in here, he says, to be an honest banker, or don't steal the peas. And then he mentions in the book where that idea comes from. And it comes from this idea, this acronym, or this phrase, EVA, economic value added. And then in the book, he references a 1993 Fortune magazine article titled "The Real Key to Creating Wealth" by Sean Tully. And so then I got that article. If you go to, you guys, I'm not sure if you know, but if you go to the Nelson Nash Institute and you log in under the practitioners resources, you can find that exact article. And so I read the article, and then I was trying to find where did this EVA come from? And it was in the article references this gentleman by the name of G. Bennett Stewart III. And so then I looked up G. Bennett Stewart III, and he was part of a company called Stern Stewart and Company out of New York. They were a business consulting firm. And they actually trademarked the EVA. They trademarked that concept, and then they would go to businesses and teach them the value of capital, that their capital has a cost, and they used it to increase profitability of major companies. Coca-Cola, Briggs and Stratton. They mentioned several in the article. And then I was like, oh, that's okay. So that's Nelson actually references this concept that was then kind of trademarked by this group in the 80s. And then when I looked up the idea of economic value added, it is actually based upon this concept called principal, or it's called residual income that's credited to Alfred Marshall. He's an English economist. He wrote a book in 1890 called The Principles of Economics that he published. And in there he mentions residual income. And he says profit is the residual income accruing to a firm's owner. It is a return to the investment of his own capital. And I think that's the key. The return of your own capital back to your system, your business, your family bank. And then he goes further to say residual income is a financial performance metric that measures a profit or income generated by a business or investment after accounting for the cost of capital. And so that was the 1890s. And so and then to bring this all back to Nelson, that's what Nelson he just simplified that for us, that in a way he called it don't steal the peas, and be an honest banker. And what that really means is your dollars sitting in your family system could be a savings account, could be a coffee can, it could be a CD, it could be anywhere. If you use those dollars to purchase something, he also says in the book large purchases, because I think it's just too hard to micromanage it. So anything that a large purchase, a new furnace, an investment, an emergency, fixing a new roof, whatever, like anything that has like some significant dollars to it. If you want to pay for that with cash, you just have to be aware that cash has a cost.
Mhm.
And it's actually the retail cost at the moment in time that you do that purchase, whatever the retail cost of interest is, that's the cost. And create an amortization schedule for yourself pick your time frame, 5 years, let's say, and then pay yourself back. And if you just do that simple thing, you will recapture, all those dollars that were flowing out of your family system and gone forever. They'll bring them back in because you recognize that your capital has a cost and you need to respect it.
Well done. I feel like we should do like this when you do a poetry. That's fascinating. Like when you first shared that, I thought that was so interesting to trace it back. And I think it speaks to like one of the initial reactions I had is just one of the like a concept is like someone who really understands something, you can tell how much they understand it by how well they're able to simplify it.
Yeah.
Like when I first learned IBC, for example, and someone else asked me, "Oh, okay, what's this IBC thing you're talking about?" I didn't know how to talk about it. I
Yeah.
didn't understand it as much as I do now, obviously. And to a much greater degree, we can see Nelson and his well-read background of he probably
Mm-hmm.
read Alfred. What's his name?
Yep.
Alfred Morris.
Yeah,
And
it
he probably
was
read Sir Arthur
Alfred
Benedict
Marshall.
III.
Yep.
And all these guys, he probably knew them and was able to just package it all in his Southern charm and put it in 90 pages and 10 of those pages probably being numbers. So like that just speaks so loudly to his grasp of economics, to his
Mm-hmm.
understanding of just really of the day-to-day you and me level of what we're actually dealing with and then correlating it all into this one, I think, beautiful strategy and concept and philosophy even and approach. And there's so much to it. I think is just so valuable, but just to see how much he knows and how much he's able to simplify it is just incredible.
Yeah. Yeah. If you can't explain something to me like I'm a 5-year-old, then that should cause us to pause and really try to decipher what's going on and how we can do better at understanding these larger concepts. But Yeah, such a great historical review, all the way back to what was it, 1890s, if not before
Yep.
then.
Yep.
And probably did go before that. But you get
Right.
down this rabbit hole and trying to figure out who's the originator, and it just
Yep.
seems like it's just wisdom, right? Being an honest banker is just being wise, understanding that the dollars that I have access to are the dollars that God has given me the ability to generate. There's a cost with it, and you should expect a return on that cost. So,
Yeah, and I think that's like the biggest key learning from that is we just assume that our cash is free. It's in
mhm.
our savings account. It's doing a job, right? It's gaining some interest, but
Yeah.
it could potentially be doing a bigger job or better job or blessing your family in a better way. And also in the book, he mentions when you're talking about this concept of how, 1890s, it goes even farther back, as Nelson even says in his book that um, it is far this idea EVA it's far from the newest. On the contrary, earning more than the cost of capital is about the oldest idea in enterprise. So he's talking about older than 1890.
Oh
And
yeah.
but then he says, but just as Greece's glories were forgotten in the Dark Ages to be rediscovered in the Renaissance, so
Mm.
the idea behind EVA or don't steal the peas or residual income has often been lost in the darker muddles of accounting. And then he says managers and investors, or us, who come upon it act as if they've seen a revelation. And that really struck me too, because isn't that kind of art? Isn't that your experiences too? Like when we caught the idea of infinite banking and using early cash value whole life insurance as our family banking system, it
Mhm.
was just like the shot out of the blue, like why did I never see this before? Or why has no one ever told me this before? Like he says, it's a revelation. That's so true. And I was thinking about it. I've had two revelations in my infinite banking journey. The first revelation was when I caught the idea of that. I didn't even know there was this product. Okay, so we can be an honest banker, which means your dollars have cost and you need to pay yourself back with interest. And that could be a savings account, it could be a coffee can, it could be anywhere. But that then begs the next question. Where is the best place to store your dollars? It's obviously there's better places than a coffee can. And I always thought the best place would be a high yield savings account until I was presented with, well, actually, there's an even better place you can store your dollars, and it's in an early cash value, permanent dividend paying whole life insurance policy. And so that was a first revelation because not only I'm getting instantly millions of tax-free dollars to protect my family for the same dollar that I was putting into a savings account. I am now getting millions of dollars of protection for my family. I'm getting a better internal rate of return than my high yield savings account because I'm getting tax deferred growth versus taxed growth.
Mhm.
I'm getting guaranteed contractual growth, not tied to the stock market, so it doesn't vary up or down the way the stock market or the economy is going. I have this contractual right to always have access to my cash for any reason without ever having to ask for approval. I'm getting uninterrupted compound growth while I'm using it because I'm never actually removing my cash. The moment you remove your dollars from your savings account, you've just disrupted the compound growth curve. And so I'm getting uninterrupted compound growth. I'm getting estate protection and an opportunity for generational wealth. And I'm building this opportunity for tax-free passive income in my retirement years. It's private. It has creditor protection. I was like, why would I not put my dollars in this thing instead of my savings account? Right. So that was the first revelation. And then the second revelation was this idea of being an honest banker. That now that I have this optimal place to store my family, my cash, when I want to use it for an opportunity or an investment or an emergency, when those dollars flow out of my system, that's the second revelation is I have to set an amortization schedule, set it over 5 years, whatever makes sense, whatever meets your cash flow needs, and get those dollars back because my dollars have a cost. And if they just go out of my system and I never return them, then they're gone forever. So that was like revelation number two. And that one, and if the listeners or viewers want to, if you that one really the light bulb went off when I was going through the Truth Concepts borrowing strategy calculator, and I was doing different scenarios of buying cars over time with cash, buying cars over time with a bank loan, buying cars over time using a early cash value whole life insurance policy. That's when that second revelation hit. I was like, wow, I could just by paying myself back, I'm getting millions of dollars back into my family system over, 40 years or some period of time. But it blew me away. And that's really when that clicked about what being an honest banker really means. And so there's like, where's the most optimal place to store your cash and build cash and protect your family? Early cash value dividend paying whole life insurance. What's the most optimal way to use those dollars is use them for purchases, but make sure you consider the cost of your capital and pay yourself back with interest. If you do those two simple things, you'll be so far, and that's what Nelson says in the book, you'll be so far ahead of your peers by just doing those two simple things that really, it just kind of it blows my mind all over again.
How would you define cost of capital?
Well, the way I would define it in terms of how I'm thinking about it is if I was going to get capital from a bank, what would they charge me for it? And that's usually like the cost of capital at that moment in time. So if you're going to buy a car, it would be 7% right now. And so that's how you'd figure out that personal amortization schedule. And that's what I call cost of capital, is whatever the retail cost is for dollars if I went to go outside of my system to get them.
Yeah. And it's even interesting, I think back to like the parable of the talents, where you can earn interest at a bank essentially. And so that's like the lending cost of capital. That there's also like what you can earn,
Hmm.
which is maybe going to be slightly less. I think on the majority, that margin, there's generally a higher cost to
Typically.
borrow than to earn, at least just in like an interest bearing, even in whole life insurance. And
Hmm.
so I just think it's just so fascinating to think about like the nature of money, like particularly with a Federal Reserve kind of central banking system where the target, it's a moving target, it's always changing, and we can understand that this dollar is associated with several velocity directions that it could potentially be going. And oftentimes we just see people, I see lots of clients like parked in a 0.2% checking account or parked in a
Mm.
2% high yield savings or something that they think is great. And
Yep.
it's not respecting that dollar. I think that some other people I've heard say that word is
Yep.
respecting the dollar. And particularly when you actually spend or leverage that dollar, like what you're putting it into. Is it going to at least give you in value, maybe not in like monetary returns, but
Hmm.
in value to the cost of the cap? And are you willing to
Right.
repay yourself, in an honest
Right.
way? So
Right.
yeah, that's
That
that's a huge revelation.
Hmm.
that's a good checks and balance for ourselves of, you know, purchases that we're going to make with our dollars of, hey, does that car, does that dishwasher, does that um, new shed, does that return value greater than the cost of capital? Because those dollars are going to be spent, they're going to be gone, but the benefit to me or to my family, is it there? Is the value there that supersedes the cost that I am paying for those dollars? And if it does, then that can be seen as a prudent purchase. But
Yep.
if you really can't justify it, if you say, you know what, I really have a hard time believing that this shed in our backyard that we only use to store our winter shovels is really worth what I'm paying for it.
Yeah.
So
You
yeah,
know, and I have
checks.
a practical example too so we cleaned the roof, and that's 4K, and we're buying we're replacing this old double wall oven that's 2,500, so that's $6,500. Like it's interesting. Once your mind shifts, once that paradigm shifts, I'm like, that's $6,500 that's leaving my system to never come back again. So I'm going to create my own 5-year note.
Yeah.
Personally, I'm going to amortize that 6,500. I'm going to get I've already spent the cash out of my savings account.
Hmm.
Now I'm going to go to my policy loan. I'm going to get a policy loan for $6,500, bring those dollars back into my account, and I'm going to create an amortization schedule that's going to pay that all back in 5 years. And so, and we have enough free cash flow to do that. So that's a key. You have to have enough cash flow to be able to do that. And that's actually one of those checks and balances. Do I have enough monthly cash flow to pay that personal note that I'm creating?
Hmm.
If you do, then that's then yes, then do that. But if you don't have enough cash flow, then it might make more sense, and you happen to have the cash sitting there because you had some kind of windfall, it might make more sense to just, if you need the thing, if it's something you need, then yeah, it might make more sense to pay cash for it directly. But if you have the cash flow to support it, create a schedule and pay yourself back to reclaim those dollars that flowed out of your system, even for a roof cleaning and new ovens. It'll all come back. So I'm like, okay, in 5 years, I'll have all those dollars back in my system. I can then redeploy them.
Hmm. Hmm.
I have two thoughts on that. One, circling back to us talking about value. I just looked it up real quick. The Oscar Wilde. Have y'all heard his quote on that?
Hmm.
He
Mm.
says, "What is a cynic?" He said, "A cynic is a man who knows the price of everything and the value of nothing."
Mm.
So I just think that's interesting. Oscar
Isn't that true?
I coined that, right?
Wow, that's
Really dive.
good.
We could have a whole episode on that. And
Hmm.
uh, and then the second part where you're talking about cash flow that I often see, maybe, I'm in maybe some circles that are in church communities and other communities. Say there's like a pastor who by design is probably not bringing in 500,000 a year, like making
Right.
lots of money and having lots of surplus cash flow, or other people who maybe are in that similar situation. Like I see it so often where it's like if you just did like an audit of where even the limited cash flow is going, say
Hmm.
401k, car payment, some other, like, my point is in those tight cash flow situations, you could do two things. One, audit where those dollars are going and if those
Yeah.
are actually bringing, like we're saying, the value that you hope, the cost of capital that it's costing you, that it's giving you. And two, like, can you invest in yourself to be more productive, to produce more income, and to increase that margin that you probably desire anyway?
Yeah.
That maybe Wall Street, financial institutions, all the marketing out there uh, kind of pressures and encourages the common citizen not to be as productive as possible and invest in themselves, but just to delegate it all to their, portfolios and mutual funds.
Yeah. Right.
Um, and so even in the tight cash flow situations, it's like there's ways around even understanding that to then be able to pay premium probably and
Hmm.
have more surplus cash flow to optimize on that front and then create more velocities, with those dollars. And
Yep.
it just kind of gets better and better
Yep.
from
Yeah.
there.
Yep. And I think it does start from kind of an understanding of like frugality is I know we've talked about kind of limiting beliefs and those sorts of things, and we don't always want to just assume like um, I'm not able to achieve more or do better. But there's value in a little bit of frugality of recognizing that a Toyota Corolla is going to produce, in my opinion, the same value for me as a Mercedes Benz. Like it's the cost of capital to finance that Mercedes Benz is not worth it to me. Like that,
Right.
it's not generating, in my opinion, is not going to be generating enough additional value to justify that cost of capital.
Right.
And so, being more frugally minded in that way allows me to do those things that John's talking about, where I now have that surplus cash flow to go and reinvest in myself and get the velocity of money moving in my favor rather than against me in something that isn't going to return enough of a value proposition to justify that cost.
Yeah.
So, yeah,
Yeah.
I
Yeah.
there's a lot of people kind of bash on frugality in our culture today, especially in the personal finance space. But I do think that you're just not being prudent enough if you're not willing to recognize that value proposition of some of those expenses in your life.
Middle class, probably generally, even upper middle class.
Yeah.
I think that's where it applies. If you're like 100 millionaire and you have tons and tons of cash flow coming in, maybe the Mercedes does make sense and you don't
Yeah.
necessarily have to be prudent, but you've, taken the time to create the value to produce the income to get you to that spot. If you're not
Right.
at that spot yet, then that's where I think it really does play in and to increase that margin over time.
Right. And the vast majority of people entering the workforce are starting in the negative.
Yeah.
It's just you're saddled with debt. And so you have to recognize that those other value proposition things are not justifiable when you're starting from behind already. But when you get to that point, yeah, maybe then it can be justified for you. But yeah, for the vast majority of Americans, at least, it's you gotta do the grunt work early on in your life, to be able to enjoy some of those benefits later on.
Yeah, I think just mainly going through the exercise, the value added exercise. If you decide that I'm driving every single day, 30 miles a day, I'm getting value in just enjoying my next level up above a Toyota Corolla, sure. But
Yeah.
you've made like you've done like the emotional math, the financial math, and yeah, and I can totally get that too because there's value, and sometimes it might not be the most prudent thing to do, but if it makes that drive to work every day just 10% better, there might be some value in it.
Yeah. Yeah. Well said, guys. Well, thank you to our listeners for uh, taking their time to spend with us and to hear us kind of spiff on some of these bigger, larger concepts that Nelson has taught. We would certainly encourage our listeners, go ahead, pick up that book, find it on Amazon, and just devour it over a weekend. And then when the time is right, come reach out to us at thefamilybankingshow@gmail.com. And one of us three would be thrilled to sit down with you and your family and figure out how to put this into practice for you. If you had any questions between now and then, you know how to reach out to us. And guys, with that, we will say goodbye and have a great week.
Have a good week, guys.
Thanks.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.